March 16, 2020, 11:47 p.m. I was sitting in my corner office on the 48th floor of JP Morgan Chase's headquarters, watching the numbers flash red across every screen. The Dow Jones had just crashed 2,997 points, the worst single-day drop in Wall Street history. Outside my window, Manhattan looked eerily quiet, but inside these walls, panic was spreading like wildfire. My phone had been ringing nonstop for 18 hours. Treasury Secretary Mnuchin, Fed Chairman Powell, CEOs of every major bank in America. Everyone wanted to know the same thing. Was this the end? Were we looking at another 2008? Maybe something worse? I've been in this business for over 4 decades. I've survived 5 major market crashes, 3 recessions, and 1 global financial meltdown that nearly destroyed the entire banking system. But sitting there that night, watching trillions of dollars evaporate in real time, even I felt the familiar knot forming in my stomach. The difference is I've learned to channel that fear into something else entirely, something that's made JP Morgan Chase the most profitable bank in history and turned every market crash into the biggest opportunity of my career. Let me tell you how I've turned 40 years of market panic into a systematic approach for building extraordinary wealth. Because what I'm about to share with you isn't just theory. It's the exact playbook that's generated over $500 billion in profits for my shareholders, and the strategy that transformed March 2020 from our worst nightmare into our greatest triumph. The lesson that nearly destroyed my career. But first, I need to take you back to where it all began. October 19th, 1987, I was 31 years old, working at a commercial credit company under Sandy Weil. I thought I knew everything about finance, about markets, about risk management. I was dead wrong. That morning, the Dow Jones opened down 200 points. By lunch, we were down 400. By 2 p.m., down 508 points, a 22.6% crash in a single day. I watched in horror as our entire portfolio imploded in 6 hours. Companies I'd analyzed for months, investments I'd staked my reputation on, all worthless. I remember standing on the trading floor, watching seasoned professionals, guys who'd been doing this for 20 years, literally crying at their desks, phones ringing endlessly with margin calls, clients screaming to sell everything at any price, the air thick with cigarette smoke and pure terror. My first instinct was the same as everyone else's. Sell everything, cut our losses, preserve what little capital we had left. That's what every fiber of my being was telling me to do. Sandy Will grabbed my shoulder. "Jamie," he said, his voice eerily calm despite the chaos around us, "what do you see when you look at these prices?" "I see disaster," I replied. "I see our portfolio getting destroyed." He smiled. "I see a 40% discount on some of the best companies in America. The question is, are you going to let emotion make this decision, or are you going to trust the math?" That was the moment that changed everything. While everyone else was selling, Sandy had me buy. IBM at $103, down from $175. McDonald's at $46, down from $71. Coca-Cola at $33, down from $54. Blue chip companies trading at prices not seen in 5 years. I thought he'd lost his mind. I was terrified we'd lose even more money on stocks that were clearly in free fall. But I followed orders. Within 18 months, those crazy purchases had generated a 180% return. IBM alone made us $47 million. I learned the most valuable lesson in my career. The greatest opportunities in finance are disguised as disasters. The birth of the panic protocol. That experience taught me something crucial. Markets aren't rational, they're emotional, and emotions create patterns, predictable patterns that if you understand them become incredibly profitable. Over the next 30 years, I developed what I call my panic protocol, a systematic approach to turning market crashes into massive profits. I've refined it through every crisis since the 1990 recession, the 1998 Asian financial crisis, the dot-com crash, September 11th, the 2008 financial meltdown, the 2020 pandemic, and every smaller correction in between. The protocol has 3 core principles. Principle 1, cash is ammunition, not shelter. Most people think of cash as a place to hide when markets get scary. I think of cash as what allows you to hunt when markets get cheap. JP Morgan maintains a cash reserve of over $150 billion. Not because we're scared, but because we're prepared. I learned this the hard way in 1998 during the long-term capital management crisis. LTCM was a hedge fund run by Nobel Prize winners managing $126 billion with 25-to-1 leverage. When Russia defaulted on its bonds, LTCM lost $4.6 billion in 6 weeks and nearly took down half of Wall Street with them. I was president of Citigroup then, and I watched as banks with no cash reserves couldn't take advantage of the incredible opportunities that crisis created. We had kept $12 billion in cash. Everyone thought we were being overly conservative, but that cash allowed us to buy assets at 30 cents on the dollar while our competitors begged for bailouts. Cash isn't just money sitting idle. Cash is opportunity waiting to happen. Principle 2, study fundamentals, ignore headlines. In March 2020, while every news channel was screaming about economic collapse, my team was analyzing something entirely different: credit card spending data, small business loan applications, consumer savings rates, employment data, the real economy, not the media narrative. What we discovered was shocking. Despite the stock market crash, American consumers had actually increased their savings by $1.6 trillion due to government stimulus. Small businesses were adapting faster than anyone expected. The economy wasn't collapsing. It was transforming. I remember a conversation with my head of consumer banking, Jennifer Peepsack. Jamie, she said, the data doesn't match the panic. Consumer spending is down only 15%, but retail stocks are down 50%. There's a massive disconnect here. She was right. While CNBC broadcast doom and gloom, we were buying bank stocks, energy companies, and retail assets that the panic had made ridiculously cheap. JetBlue at $7 per share, Marriott at $65, energy companies trading below book value. The media tells you what happened yesterday. The data tells you what's happening tomorrow. Principle 3, bet against human nature. This is the hardest principle to follow because it requires you to do everything your brain tells you not to do. When markets crash, every instinct screams, sell everything and hide. I've trained myself to do the exact opposite. During the 2008 financial crisis, as Bear Stearns collapsed and panic consumed Wall Street, I increased JP Morgan's stock buyback program by 400%. I was literally betting the bank that our own stock, down 50% from its peak, was undervalued. My board thought I'd lost my mind. Jamie, one director, said, we're in the middle of the worst financial crisis since the Depression. This isn't the time to be taking risks. But that's exactly when you should be taking calculated risks. When smart people make emotional decisions, they create opportunities for patient people making logical decisions. JP Morgan's stock returned over 300% in the following 5 years. The phone call that changed everything. Let me tell you about the moment that crystallized my entire approach to market panic. It was September 15th, 2008, 6:30 a.m. Lehman Brothers had just filed for bankruptcy. AIG was hours away from collapse. The entire global financial system was teetering on the edge of complete meltdown. My phone rang. It was Hank Paulson, Treasury Secretary. Jamie, we need you to look at Washington Mutual. They've got $307 billion in assets, but they're bleeding cash. If they go down, it could trigger a complete bank run. Washington Mutual was the 6th largest bank in America, but they were drowning in subprime mortgages. Their stock had fallen from $45 to $2 in 6 months. Every rational analysis said it was toxic, unsalvageable, a disaster waiting to happen. That's exactly why I knew it was an opportunity. I spent the next 72 hours with my team diving deep into WAMU's portfolio. Yes, they had terrible subprime mortgages. Yes, they were technically insolvent, but buried in that mess were 43,000 employees, 2,200 branches, and millions of customer relationships in some of the fastest growing markets in America. Most importantly, the panic had created a once-in-a-lifetime buying opportunity. The $1.9 billion bet that made history. On September 25th, 2008, I made the call. JP Morgan would acquire Washington Mutual for $1.9 billion, a 95% discount to what the bank had been worth just 2 years earlier. The media went insane. Dimon's folly, the Wall Street Journal called it. JP Morgan catches a falling knife, said the Financial Times. My own executive committee was split 50 on whether I just destroyed the bank. But I saw something they didn't see. The panic had created such extreme pricing that we were essentially buying $300 billion in assets for less than $2 billion. Even if half those assets were worthless, we'd still make a fortune. I was right. By 2012, that crazy Washington Mutual purchase had generated over $28 billion in profits for JP Morgan. The toxic mortgages, many of them recovered as the housing market stabilized. The branch network, it gave us dominant market share in California, Florida, and the Pacific Northwest. The deposits, They became the foundation for billions in profitable lending. More importantly, it established a principle I've followed ever since: when everyone else is running toward the exit, you run toward the opportunity. The $150 billion war chest. This is why I maintain one of the largest cash positions in corporate America. People constantly ask me, Jamie, why are you sitting on $150 billion, earning nothing in money market funds? That's inefficient capital allocation. They're missing the point entirely. That cash isn't earning much today, but it's earning optionality, the ability to act decisively when others can't, the ammunition to take advantage of opportunities that only exist during moments of maximum panic. During the 2020 crash, while airlines begged for bailouts and retailers filed for bankruptcy, we were making acquisitions, increasing market share, and positioning for the recovery. We bought corporate bonds from panic sellers at 60 cents on the dollar. We increased lending to quality borrowers by $50 billion while competitors retreated. We expanded into markets others were abandoning. The result? We ended 2020 with record profits of $29.1 billion, not despite the crisis, but because of how we responded to it. So, psychology of panic profits. But here's what most people don't understand about my approach. It's not really about finance. It's about psychology. Understanding that markets aren't driven by rational analysis. They're driven by human emotion. And humans, when scared, make predictably irrational choices. I've watched this pattern repeat itself in every major crash. Phase 1, denial. This is just a correction. The fundamentals are strong. It'll bounce back in a few weeks. Phase 2, hope the Fed will cut rates. The government will intervene. This can't last much longer. Phase 3, fear. Maybe this is more serious than we thought. We should probably reduce our exposure. Phase 4, panic, sell everything. Get out now. We're going to lose everything if we don't act. Phase 5, capitulation. The market may never recover. Maybe this time really is different. Most investors get trapped in phases 4 and 5. They sell at the worst possible moment and miss the recovery entirely. I've trained myself to recognize these phases and act counter to them. When markets hit phase 4 or 5, I become aggressively opportunistic. Let me give you 3 specific examples of how this works in practice. Trade hash 1, the Bear Stearns acquisition, March 2008. Bear Stearns was the 5th largest investment bank in America with 85 years of history and $395 billion in assets. In March 2008, they were trading at $62 per share. Then rumors started spreading about their liquidity problems. Within 5 days, the stock fell to $2. The firm was hours away from bankruptcy. The Federal Reserve called me on a Friday night. Jamie, Bear is finished, but if they file for bankruptcy Monday morning, it could trigger a complete collapse of the credit markets. We need you to consider an acquisition. Every instinct told me to walk away. Bear Stearns was toxic. Their mortgage portfolio was imploding. Their reputation was destroyed. Why would I want to contaminate JP Morgan with their problems? But then I looked at the assets. Prime Manhattan real estate worth $8 billion. A world-class prime brokerage business serving hedge funds globally. 14,000 employees who understood derivatives and fixed income better than anyone on Wall Street. Most importantly, the panic had created such extreme pricing that we could buy the entire company for less than their Manhattan headquarters was worth. I offered $2 per share, $240 million for the entire company. The Bear Stearns board accepted within hours. By 2013, that acquisition had generated over $11 billion in profits for JP Morgan. The prime brokerage business alone was worth more than we paid for the entire company. Trade hash 2, energy sector lending, March 2020. When oil prices briefly went negative in April 2020, every bank on earth reduced energy lending. The consensus was clear. The energy sector was finished. Electric vehicles were the future. Renewable energy was taking over. Oil companies would never recover. I saw something different. Yes, long-term trends favored renewables, but the world still used 100 million barrels of oil per day, and that wasn't changing overnight. The panic had created massive opportunities in high-quality energy companies with strong balance sheets and low production costs. While competitors cut energy lending by 40%, we increased it by $12 billion. We focused on companies like ExxonMobil, ConocoPhillips, and Pioneer Natural Resources, firms with decades of reserves and proven ability to generate cash flows even at $40 oil. When energy prices recovered in 2020 and 2022, reaching $120 per barrel, those loans generated exceptional returns. Our energy portfolio became one of our most profitable business lines. Trade 3, commercial real estate, April 2020. As COVID lockdowns began, everyone assumed commercial real estate was finished. Office buildings would become obsolete. Retail was dead. Hotels and restaurants would never recover. REITs fell 50% across the board. But I've learned to separate temporary disruptions from permanent trends. Yes, work from home was accelerating. Yes, e-commerce was growing faster. But Manhattan office buildings, trophy retail assets, and prime hotels don't just disappear. They get repriced. We increased commercial real estate lending by $23 billion in 2020, focusing on Class A properties in gateway cities with strong long-term fundamentals. We bought distressed REIT bonds at 40 cents on the dollar. We provided bridge financing to quality developers who couldn't access traditional capital markets. As the economy reopened in 2020, 2022, commercial real estate values recovered dramatically. Our CRE portfolio generated returns that exceeded every other business line, the contrarian's playbook. So how do I actually implement this strategy? What specific steps do I take when markets start crashing? Step one, the 48-hour freeze. When panic begins, I institute a 48-hour hold on all major investment decisions across the entire firm. No buying, no selling, just analysis. This prevents emotional reactions and allows time for rational assessment. I learned this from watching the 1987 crash, when firms that made quick decisions often made terrible decisions. Fear and greed are equally dangerous in the heat of the moment. Never make permanent investment decisions, I tell my team, based on temporary market emotions. Step two, the data immersion. While others watch CNBC and read panic headlines, my team goes into what I call data immersion mode. We analyze leading economic indicators, employment data, consumer spending patterns, business investment flows, credit spreads, yield curves. We're looking for disconnects between market prices and economic reality. In March 2020, for example, airline stocks fell 70%, even though domestic air travel was down only 30% and international travel was recovering. The market was pricing in permanent structural change when the data suggested temporary cyclical disruption. Step three, the opportunity audit. JP Morgan maintains what I call our crisis acquisition list, hundreds of companies and assets we'd want to buy if prices fell to specific levels. When panic hits, we already know exactly what to target instead of making emotional decisions in real time. This list includes everything from individual stocks to entire companies, from corporate bonds to real estate assets, from commodities to currencies. Each asset has a target price based on fundamental analysis, not market sentiment. Step four, the stress testing. Before making any contrarian moves, we model worst-case scenarios that go far beyond what the market is currently pricing in. What if the recession lasts 3 years instead of 18 months? What if unemployment hits 15%? What if commercial real estate values fall another 50%? Only investments that survive these extreme stress tests get approved for deployment during crisis periods. Step five, the staged deployment. I never go all in at once, no matter how attractive the opportunities look. I deploy our cash reserves in stages as panic deepens, always keeping ammunition for even better opportunities that might emerge. During the 2020 crash, we deployed 30% of our available cash when markets fell 20%, another 30% when they fell 30%, the final 40% when they reached maximum panic in late March. This approach ensures we capture the bulk of the opportunity without trying to time the exact bottom, which is impossible anyway. The emotional mastery factor. But perhaps the most crucial element of my approach isn't financial, it's emotional. The ability to remain calm, analytical, and opportunistic when everyone around you is losing their minds. I've spent decades training myself to separate my emotions from my analysis. When markets crash, every human instinct screams at you to protect what you have, to avoid additional risk, to seek safety above all else. These instincts served our ancestors well when avoiding predators. They're disastrous when building wealth in modern financial markets. I remember a conversation with my wife, Judy, during the 2008 crisis. Jamie, she said, everyone's saying this is worse than the Depression. Maybe you should be more conservative. Focus on protecting what we have rather than taking new risks. It was a fair point. The media was filled with apocalyptic predictions. Respected economists were talking about systemic collapse. Even some of my own executives were urging caution. But I studied the Great Depression extensively. I knew that the investors who built generational wealth during that period weren't the ones who hid in cash and government bonds. They were the ones who bought quality assets at Depression-era prices and held them through the recovery. The $2 trillion revelation, my most audacious move came in March 2020, when the Federal Reserve announced unlimited quantitative easing, essentially printing trillions of dollars to prevent economic collapse. Most of Wall Street celebrated this as a rescue. I saw it as a warning. When the government creates $2 trillion out of thin air overnight, I told my executive team that money has to go somewhere, and wherever it goes, it's going to create massive distortions. So while other banks relaxed and celebrated the Fed's intervention, JP Morgan began preparing for the inevitable consequences: inflation, asset bubbles, and eventually much higher interest rates. We reduced our duration risk in bonds. We increased positions in inflation-protected securities, commodities, and real assets. We even bought gold for the first time since the 1970s, something that shocked many of our institutional clients. Most importantly, we prepared our balance sheet for rising interest rates. While competitors were celebrating record low borrowing costs, we were positioning for a world where those rates would eventually normalize. The result? When inflation hit 9.1% in 2022, and the Fed raised rates from 0% to 5.25%, JP Morgan's profits soared to record levels while competitors struggled with massive losses on their bond portfolios. The $5 trillion lesson. Over 4 decades, I've learned that the biggest money in finance isn't made during bull markets, when everyone's making money. It's made during bear markets, during crashes, during moments of maximum panic when most people can't think clearly. The reason is simple. Fear creates massive pricing inefficiencies. When people are terrified, they sell quality assets at irrational prices. When they're euphoric, they buy mediocre assets at irrational prices. I've built my entire career around exploiting these emotional extremes. Buy when others are panic selling, sell when others are euphoria buying, hold when others are flip-flopping based on daily market movements. It sounds simple, but it's incredibly difficult to execute because it requires you to act counter to every human instinct you have. The practical playbook for individual investors. Now, you might be thinking, Jamie, that's all very interesting, but I'm not running a $1 trillion bank. How does this apply to someone with a regular portfolio? The principles are exactly the same, just scaled differently. 1, build your ammunition before you need it. Maintain 12 minus 24 months of living expenses in cash, not for safety, but for opportunity. When quality stocks fall 40 to 50% during the next crash, this cash becomes your weapon for buying world-class companies at fire sale prices. Most people keep minimal cash because it earns nothing. I keep maximum cash because it earns everything when deployed correctly during panics. 2, create your crisis shopping list. Identify 20 MIA's 30 high-quality companies you'd love to own at the right price. Study their businesses, understand their competitive advantages, know what they're worth in normalized conditions. When the next crash comes, and it will come, you'll already know exactly what to buy instead of making emotional decisions while markets are falling. 3, ignore the noise, study the signal. During crashes, turn off CNBC. Ignore Twitter. Stop reading panic headlines. Instead, focus on actual business fundamentals: earnings, cash flows, market positions, competitive advantages. The media amplifies emotion. The data reveals opportunity. 4, deploy systematically, not emotionally. Never invest all your panic money at once. Buy some when markets fall 20%. Buy more at 30%. Buy even more at 40%. You can't time the exact bottom, but you can build positions as prices get increasingly attractive. 5, think in decades, not quarters. Panic buying isn't about timing a quick bounce. It's about buying quality businesses at temporary discounts and holding them for long-term wealth creation. Amazon fell 90% during the dot-com crash. Apple fell 70% during the 2008 crisis. Netflix fell 80% during the 2022 correction. The companies that recovered weren't lucky. They were quality businesses temporarily mispriced by panic. The $1 trillion transfer. Here's the ultimate truth about market crashes. They don't destroy wealth. They transfer it from the emotional to the rational, from the panicked to the patient, from those who sell low to those who buy low. I've been on the receiving end of these transfers for 4 decades, not because I'm smarter than everyone else, but because I've trained myself to think differently when it matters most. The next market crash is coming, maybe this year, maybe in 5 years, but it's coming. The only question is, which side of the wealth transfer will you be on? During the last 5 major crashes, I've generated over $150 billion in profits for JP Morgan shareholders by following these exact principles. Not by being lucky, not by having insider information, but by staying rational when others became emotional. The final lesson. As I write this in late 2024, Markets are at all-time highs. Valuations are stretched. Investor sentiment is euphoric. Everyone's making money and everyone thinks they're a genius. This is exactly when the next opportunity is being created. When markets are expensive, future returns are low. When markets are cheap, future returns are high. It's that simple. I'm currently sitting on the largest cash position in JP Morgan's history, over $180 billion. Not because I'm scared of markets, but because I'm preparing for the next great opportunity. When the next crash comes, and it will come, I'll be ready to deploy that cash into quality assets at discounted prices. While others are panicking and selling, I'll be buying systematically and patiently. That's how you turn market crashes into generational wealth. That's how you profit from panic. And that's how you build the kind of fortune that lasts for decades, not quarters. The choice is yours. When the next crisis hits, will you be part of the panic or will you be part of the solution? I know which side I'll be on. The same side I've been on for 40 years. The winning side,